Maggie, are we live? We're live. It's Wednesday, time for another Nuview workshop. Thanks everybody for joining us. If you're joining us on Facebook Live, thank you. If you're joining us via the Zoom link, thank you as well. We have a great presentation for you guys today. But first, I want to introduce our premier sponsor for the day that allows us to have these great workshops. This is a good friend of mine in Texas. His name is Steve Liang. Steve, you there? You want to just pop your camera on and and unmute yourself? I want to introduce you guys to Steve Liang. He's going to talk a little bit about what he's got and that's very, very beneficial to those of you who are investing in real estate or thinking about investing in real estate. Just give you a little background. Me and Steve go way back from my days in Texas. He's got a company that provides a service, a great service to real estate investors, and they are branching out. They have actually been branching out to other states to offer their services. And one of those states that they're really targeting is the state of Florida, which is where we are located here at Nuview Trust Company. And I just wanted to have Steve come on, thank him for coming on, and give him a little bit of time to share with you his product and service that will help you guys as real estate investors.
So Real Estate IQ, we are a prop tech platform, which means we are a property technology and a data company. We are based in Texas. Last year, we had a little over 1,000 clients in Texas that are active real estate investors. They're using our data to acquire properties and grow their portfolio. After about 8 years in business, we see that this platform can be very helpful on a national level. So we want to take this national, and Florida is one of the key markets that we are focusing on this quarter. So we want to bring this platform to you, and thank you for being here and kind of listening about what we do. So we focus on off-market data, and these are our key uniques. We offer you the freshest deals data. Most of the information is when it hits the courthouse public record, we'll have it for you in under 2 days. We have the freshest data in the industry. So that gives you a first mover advantage as a real estate investor. We also have the best coverage of deals data. We have 12 different types of motivated sellers, ranging from foreclosure, probate, appointment of substitute trustee, all the way to divorce. And we're now adding water shut off list. So that's over $2,000 worth of value. And through all this data, you can basically do list stacking and find the best opportunity that you can hit on. So that's a huge advantage when it comes to hitting the deals. And thirdly, we have first-hand data. This means we mine our own data. We're not like other companies where they source third-party data, and by the time you get it, it's number one, more expensive, and also a little bit later than everybody else. So we give you a lot of value because we are mining our own data, and we can offer you our data at just a fraction of the cost. We're giving $2,000 per month of value at $100 to $200. So we always like offering 10x value. So if we're gonna give you about $2,000 a month of value, we charge typically $100 to $200 a month. So that has been our kind of success formula in Texas and a few other states that we're already in, and we want to also bring this advantage to you. Want to thank Nate and Nuview Trust for featuring us here today and really give you a really good kind of first mover advantage by knowing our product, so you can take advantage of them sooner than anybody else in Central Florida. So we're really happy about that. We also have a guarantee that you can find a deal within 90 days. Our clients typically can find a lot of success within that 90 days. And we also hope that you can take advantage of it and make that happen. So if you're interested in learning more, please visit our website at realestateiq.co, and we offer a data consultation for you to learn more about what we do. All you have to do is go on there and look for a demo link. It's usually on the top of the menu, and we look forward to talking to you. And thank you for having us.
Awesome.
Nate.
So thanks, Steve. And the reason why I wanted to bring Steve on is not only are we good friends and go back a while, but with today's topic, I'm going to talk about how to buy real estate in a self-directed IRA and actually go through the process. The one thing I can't tell you guys how to do, though, is where to find the deals. Like, how do you go find the deals? Nuview Trust Company does not have real estate to sell you. And the beautiful part about a self-directed IRA is you do get to pick your own investments. But when you have that control, you have to go and use resources to help find your investment. So what I like to always say is you don't have to actually have deals. You have to have access to deals. So access to deals can be through your local RIAs, or it could be through like phenomenal services like Real Estate IQ that help you work through lists and find off-market property. And I know a lot of clients have used their services in the past and are very, very happy with it. And we're excited to have them branching out here in Florida. And you're going to hear a lot more from Real Estate IQ as we go on to the future. So please check out their website, realestateiq.co, and we'll put their information also in the comment section on our Facebook webinar as well. So thank you, Steve. Any last words if you're still with us?
Yes, we do have a gift for you. Again, because Nuview is featuring us and bringing us on. We have 150 free leads that we'd like to offer you. If you could send me a personal email, someone on our team will reach out to you with those 150 leads. So you can take a sample of our product and see how awesome it is.
That's awesome. And what's the email they should email you at, Steve?
It is steve.liang@realestateiq.co. So I'm
Awesome.
going to also type it in on the chat.
Yeah, if you could type that into the chat, and then we'll make sure that we type that into the Facebook comments as well. Thank you again, Steve. And we look forward to doing more with you guys in the future.
Absolutely. Thank you. Thank you, Nate.
All right. Have a good rest of the Wednesday. All right. So let's jump into it. Maggie, is this the right screen that I need to be seeing, or do I need to see full screen? Okay. All right. That's it there. So let's talk about how to buy real estate tax-free in self-directed IRAs. First, kind of here's the agenda. I'm going to talk about self-directed IRAs in general for anybody that's new. Just talk real briefly about what a self-directed IRA is. What are the tax advantages that IRAs give you that you don't get as an individual? The types of plans that can be self-directed. And then we're going to talk about how you actually use retirement accounts, or specifically self-directed IRAs, to take title to property, to actually own real estate instead of owning, say, stocks or bonds or mutual funds or CDs. We're also going to talk about some considerations that you might want to make prior to buying real estate in a self-directed IRA. And then I've got 2 case studies that are going to walk you through step by step on how actual clients have taken their self-directed IRAs to buy real estate in 2 different fashions. And we'll have some learning lessons from that as well. If you have questions along the way, if you're on the Zoom link, type the questions into the Q&A or chat box. I've got one of my up-and-coming rock star IRA specialist, Tom Tantillo, here on standby. He's going to answer the questions as we go, so you don't have to wait for me to stop. Just answer any question, and it can be anything IRA related. Go ahead and type that into the chat on Zoom. And if you have questions via Facebook Live, type that into the comment section, and we will get to those questions as well. And then if there's any pertinent questions that Tom wants to relay to me at the end, as education purposes, we'll answer those live. So let's just jump right into it. All right, so let's talk about first Nuview Trust Company. For those of you who are not familiar with what a self-directed IRA custodian is, or a self-directed IRA company, simply put, we're just an alternative provider of retirement accounts than your traditional custodians like Fidelity, Charles Schwab, TD Ameritrade, and those types of companies. Now, the difference between those companies and a company like Nuview Trust is that we don't sell investments to our clients. We're still governed and regulated the same way that those trust companies are, though those custodians are, but we're not licensed securities brokers selling you investments. In our account agreement with our clients, it simply states, we'll hold anything in your IRAs that is allowed by the IRS, but you have to find the investment. Okay. Now, most people aren't used to investing that way. Most people are investing with their traditional brokerage accounts or their IRA, through their 401ks, and they're just buying stocks, bonds, and mutual funds, and they think that those are their only investment options, when truly you can invest in almost anything within an IRA. You just have to find a company that's willing to hold the investment on behalf of your IRA. So what Nuview does is we hold things that are typically outside of stocks, bonds, mutual funds, and CDs. We hold what's called alternative assets, and we'll go over what types of alternative assets I'm referring to. And I will say this, most of our clients do not just have Nuview IRAs, they have Nuview IRAs, and they also have Fidelity IRAs or Charles Schwab IRAs, because the benefit to doing that is you get true diversification in your overall investment portfolio. Okay. So one of the benefits to self-directions is that you get to diversify into investments outside of the stock market. Okay. Meaning you can invest in things like real estate, which we're talking about today. The real cool thing about real estate, when you compare it to stocks, is that first of all, each investment has its own sets of risks. So it doesn't make the investment risk-free, but if you understand real estate, it could be a better investment than just investing in stocks if you understand stocks less. There's also some fundamental differences between owning real estate and a stock. If you look at a stock is what? It's just an investment into a publicly traded company. It could be speculative to a certain degree. You have to buy it low and hope that you sell it at the high point, and it'll have its ups and downs. But the biggest difference is that it's not a tangible investment, right? If the company goes out of business that you own stock in, well, then you don't get anything. There's no fallback to that investment. But with real estate, there's a fallback. The fallback is the real estate itself, because the real estate's tangible. The land underneath it is tangible. The land underneath it is sometimes in certain areas 50% of the value. So does real estate have its ups and downs in value? Sure, it does. It's got its own cycles, just like the stock market. But at the end of the day, it's tangible. It's like this desk. You can drive by it, you can touch it, you can feel it. It's not going anywhere. And if you look at it, it's the largest segment of our economy. So I know everybody's freaking out about what real estate's going to do onto the future. I'll tell you this thing, it's not going away. So there's always going to be an opportunity to invest in real estate for the fact that it's needed, in how we live our lives, but it is a tangible investment. And if you do it right, you can see exponential returns if you buy low, sell high, but also have the ability to capture additional income streams through rents and things like that. Now, when you talk about income streams, though, when you talk about incoming rents, capital gains, all that, the real benefit of a self-directed IRA is that when you buy investments with income streams like real estate, and the fact that you can buy and sell real estate and hopefully get some capital gains there, is that when you do it within an IRA, you don't have to pay taxes. All of your profit within an IRA, any IRA, is completely either at the bare minimum tax deferred, meaning I could buy and sell a property in an IRA. I don't have to pay any taxes annually. I can roll over all of the profit into my next deal, into my next deal, into my next deal, deferring the taxes to the future. Or if I'm investing in something like a Roth IRA or a Roth 401k and HSA, well, those tools actually grow completely tax-free. Most people just don't realize they can invest in real estate with those accounts. So if you're really looking to get Uncle Sam out of your pocket when it comes to real estate investing or any investment, think about how you can start utilizing IRAs or, quote, self-directed IRAs to start making some tax-free profit and not giving, 40, 50% of your profit to Uncle Sam every year by investing with your own money. But when you are an investor and you have retirement money to invest in, I think it's just best to invest in what you know best. If you understand the stock market, more power to you, invest in the stock market. If you don't, ask yourself the question, what am I knowledgeable about? Let me apply my knowledge as an investor to my retirement assets and make better returns in the long run. That doesn't mean you're not going to stub your toe, but if you are a realtor or a real estate attorney or even a CPA that understands real estate, I see a lot of people like that who are our clients that make better returns investing their IRAs and retirement accounts in something they understand versus just investing in the stock market because that's what they think they're forced to invest in. So just invest in what you know best and understand that IRAs have great tax benefits to do it within those. And let's talk about the IRAs that we have here at Nuview Trust Company. And when I go over these plans, I want you to think of two things. One, how many of these plans can I have? Because I guarantee you, if you only have one IRA, you don't have enough. There's 7 types of tax advantage plans that we have just here at Nuview that give you tax benefits that you don't get as an individual. So lesson 1 in these next couple slides, just think to yourself, what plans do I not already have that I can have that can help eliminate taxation from my life. Number two is realize that all of these plans can invest in real estate, and they can invest separately into real estate or together in real estate. When you think about these plans, think about them as individual buyers. Okay, these buyers can partner together on the same investment. And I have a case study that shows you how a husband and wife partnered their accounts and their child's account in buying a piece of real estate that they just rehabbed and flipped. So keep that in mind. All of these plans have tax advantages that we don't get as individuals, and all of these plans can invest in real estate or other alternative assets. So the traditional IRA and Roth IRA are the ones most people are familiar with. These are your personal plans. I just did a presentation last week on Roth conversions. If you're interested in paying tax now versus paying tax later, you might want to consider doing what's called a Roth conversion from a traditional IRA to a Roth IRA. Bare minimum is you can invest either one of these plans into real estate. A lot of investors, especially self-directed IRA investors, like to use the Roth because it's basically an after-tax account where all the profit that's made after doing the investment is all completely tax-free. If you're interested in watching that class, just go back a couple days and watch the class from last week. It was a great class. We had about 100 people on. So traditional IRAs and Roth IRAs can be self-directed. You can also self-direct and use these plans to buy real estate, which would be your SEP IRA, your simple IRAs, or even have your own solo 401k, or we call it a solo QRP. These plans are specific to self-employed individuals, so you do have to have some self-employment income to use these plans. But if you are self-employed, it gives you additional options of tax advantage plans that you can put money into, direct it to buy real estate through Nuview, and again, just get more money, making money that Uncle Sam can't touch. So you want to think to yourself, how many of these plans can I have? If I have earned income, but I'm self-employed as well, you can have items from the employer plans menu. You can also have an item from the previous page menu, which would be your traditional or your Roth. Outside of that, we've also got specialty plans. Now, these specialty plans are great, and we're going to have some classes that go over these specifically. We've got some education on our YouTube page that go over these, but health savings accounts and education savings accounts, which are actually Coverdell education savings accounts, can also be self-directed. The beauty part about these plans is that they're different than retirement plans. You still make contributions in a similar fashion that you make contributions to your other plans. You can still invest these plans into the same exact investments you invest all your other retirement plans in. But when it comes to distributions, that's where it changes. Distributions out of a health savings account can be taken out immediately after you make profit to pay for qualified out-of-pocket health expenses for you and your family, which is you, spouse, and any dependents. And then the Coverdell education savings accounts are savings accounts you set up for kids, grandkids, nieces, nephews, whatever it may be. You put a little bit of money in their Coverdell education savings account. You can partner their Coverdell education savings accounts with your own accounts, your Roths or your SEPs or otherwise. But when profits made back to that child's Coverdell education account, the distributions can be taken out immediately to pay for qualified education expenses. Education expenses from kindergarten all the way through college. So that's things like tuition, uniforms, books, computers, iPads, your home internet bill, all sorts of things fall under the category of qualified education expenses and qualified health expenses. These are probably the least used because they're the most misunderstood plans out there. The cool thing about it is not only can you use the plans that I've talked about here to save for retirement, but with these plans specifically, you can start taking distributions tax-free and penalty-free to pay for your family's health expenses and your kids' education expenses. Once you start figuring out how to use these buckets to be the owners of your investments, you find that you can consume more goods with the same amount of money because Uncle Sam is out of the equation. So I'll get off my soapbox there. We've got some more classes that go over specifically those plans. I don't want to spend too much time on those because I want to get to our topic, which is buying real estate. But just remember, all of those plans can buy and own real estate separately or together. Before we talk about what real estate or how you buy real estate, let's talk real quick about the IRA restrictions. It's really important to talk about this first. There's a lot of flexibility that you get in self-directing your IRA. You get to make all the investment decisions. There's nobody selling you investments. But when you start investing in things that are alternative assets outside of the stock market, it's always good to have a reminder as to who your IRA is allowed to do business with and what investments are allowed in your IRA. Now, these are the same rules as you would have in a Fidelity IRA or a Charles Schwab IRA. They just never have to bring this up because you're never investing in anything outside of things that are publicly traded. When you invest with your self-directed IRA, you're now investing in making negotiations with sellers of real estate, borrowers of private capital. You're dealing one-on-one with individuals. So the first thing we have to tackle first is, who is your IRA allowed to do business with? And that would be the people restrictions. When we're talking about people restrictions and self-directed IRAs, or just IRAs in general, we're talking about a certain group of people that are called disqualified persons. A disqualified person is an individual that's not allowed to transact with the IRA in question. Okay. Now, if I'm talking about my IRA, the disqualified people to my IRA, the main disqualified person to my IRA would be me, myself. Okay. I am a disqualified person to my IRA. I have to remember that my IRA is a separate entity. Okay. My IRA, by definition, is a tax exempt trust. I put money in it via contributions. I pick the investments because that's how I want to retire. But I don't get the benefit from those investments until I take a distribution. Okay, that's how IRAs are set up. And there's some penalties if I want to take a distribution prior to being age 59 and a half in most cases. But I have to realize my relationship to my IRA is that I'm the fiduciary to my IRA. I have to do an act in the best interest of my IRA, and I get my benefit from distributions. So if we dig into that a little bit, what that really means is that, let's say that I own a property personally in my name. Okay. I'm not allowed as my IRA's fiduciary to tell my IRA to buy my property. That's a conflict of interest, right? That doesn't benefit my IRA. That might benefit me by getting a property sold, but I can't self-deal my own assets to my IRA. Or vice versa. I can't buy my IRA owned assets. I have to take distributions out of my IRA, but I cannot transact with my IRA. Now, this can get a little confusing because some people will say, well, what about partnering with my IRA? What if I had $50,000 in my personal name and I had $50,000 in my IRA and I wanted to buy a $100,000 house? Could I do that? Yes, you could do that, provided that the seller of that house, the person on the other side of the transaction, is not a disqualified person. So in this example here, you're seeing, just imagine there's an imaginary line or a fence, right? If you're on opposite sides of the fence, you cannot transact with your IRA. If you put you and IRA on the same side of the fence, where you're just going to put equal, or it doesn't have to be equal shares, but you're going to put in, a certain amount of capital from your IRA, a certain amount of capital from yourself, and buy property from a non-disqualified person, you can do that. But you got to be very careful with that too. You just got to make sure if you go into partnership with your IRA, that it remains what's called a parallel transaction going forward. Let's just use an example. Let's say I buy a $100,000 house. I put $60,000 from my IRA and $40,000 from me personally. I'm not going to commingle those funds. I'm going to go in and we're going to take title together as me, Nate Hare, and then my IRA, which would be Nuview Trust Company for the benefit of Nate Hare. All right. I still keep two separate owners listed, and based on the ownership percentages of what we put in at the beginning, I have to make sure that I stick with those percentages as it comes to paying expenses and collecting income. So if I start 60-40 in buying the property, I have to also rehab the property as 60-40 split. I have to share the profit as 60-40 split. I can do that, and that's perfectly within the rules. But again, I can't be on opposite ends of a transaction where my IRA is doing business with myself. If you have any questions on this too, by the way, I don't expect you guys to be experts in this. This is why we always extend an offer to do free consultations with anybody who might have a scenario, and I'll give you some places to go to get in touch with us if you ever have any questions. But we're just touching on kind of the basics here. If we're talking about all the disqualified people, and I don't want this slide to scare you, this is more just to give you an example of the nerdy things that we have to research as IRA specialists in this field, but I'm going to break it down simply. When we're talking about the people restrictions, to a IRA. I'm not talking about just me, the IRA owner. This list here, I'll break it down simply. What this list is showing is that the disqualified people to my IRA would be myself. We mentioned that. It also includes my spouse, my lineal ascendants, which would be parents, grandparents, my lineal descendants, which would be kids, grandkids, and their spouses. And all this other mumbo jumbo is any entities those people control, manage, or are highly compensated by. So just because you have an LLC, that's an extension of yourself. You can't sell property from your LLC to your IRA. It's the same thing. It's no different than selling it as yourself to your IRA. So let me just repeat that so you just got the fundamentals of it. Disqualified people to my IRA would be myself, my spouse, up the line, down the line, their spouses, and any companies those same people own, control, manage, or are highly compensated by. The reason why they disqualify those people and not say brothers, sisters, aunts, uncles, cousins, nieces, nephews is because when you die, who usually inherits your IRAs or your assets? Your spouse and your kids or your grandkids. Wealth is passed lineal or to spouses. It's not typically passed to brothers, sisters, aunts, uncles, cousins, nieces, nephews. So the black and white version of the rules is you cannot have your IRA deal with any of those individuals. Now, it could get a little complicated. For instance, I'm not married, no kids. So who is the beneficiary of my IRA? It's actually my brother. Okay, I have my brother listed on there. So even though it's not listed on this list, my IRA cannot do business with my brother because I have him listed as my beneficiary. Does that make sense? So I can't buy a property from my brother in my IRA and then I die and then he inherits that same house back in an inherited IRA. Again, just understand the rules, basic degree. Most people aren't getting tied up with any of these problems. Most people are just buying property from normal individuals. So again, just want to touch on this just so you kind of understand who not to do business with your IRA. The things that those people cannot do is they cannot buy, sell, trade, loan, or extend services to the IRA. And the last part of the restrictions I just want to mention is the two investments that are not allowed in an IRA, which would be life insurance contracts and collectibles. Those are the only two investments listed in the IRS code that are not allowed in your IRA. So if anybody tells you, no, you can't buy real estate in your IRA, that's not allowed. That probably just means they don't allow it where you have your IRA parked because they don't sell real estate or make money on real estate. So, and I just want to make a point to that too, because we get a lot of calls in from people who are interested in self-directed IRAs. They go back and they talk to their financial advisor and they come back to us and said, well, my financial advisor said, if I buy real estate in my IRA, I'm going to have to pay all these hefty taxes and penalties. Well, realize what most investment advisors are envisioning you doing when you say, I want to buy real estate with my IRA. They imagine that you are going to take a distribution from your IRA and go and buy real estate. Now, if you took a distribution from your IRA, yeah, you could be subject to taxes and penalties. They're right in that sense. But when you have a self-directed IRA, here's actually what's happening. You have an IRA still here, and you might roll over or move over cash to fund your self-directed IRA. When you find a real estate investment, we're going to exchange that asset of cash for an asset of real estate. There's no distribution involved in that case. We're just taking direction from you to change assets of cash to assets of real estate. And then when you decide to sell it, we sell that property still within the IRA, and it goes from an asset of real estate back to an asset of cash. There's no distribution there. There's no taxation that happens there. It's no different than buying a stock and Fidelity exchanging assets of cash for assets of stock and then back to assets of cash when you sell. So don't get confused when investment advisors tell you you can't do it without paying taxes. They're probably not understanding what you're really doing. Just wanted to make that point because we get that oftentimes, and it's kind of laughable at this point that they really can't get that down, those wealth advisors. So moving on. Investment choices. We've talked a lot about these. We've actually had some good webinars or workshops with other investment professionals that have talked about these. We're going to keep it real simple when we talk about buying real estate. I'm just going to show you the process. We're just going to talk about buying some single family property, but you can also buy property through foreclosures. You can buy tax liens or tax certificates in a self-directed IRA. You can partner IRAs together and invest into syndications or larger, apartment deals. You can buy real estate options. You can buy investments into condos, unimproved land, commercial property. The list goes on. And next week, we're going to talk about promissory notes. Sorry, Tom, I need that back. But we also talk about investing in promissory notes, secured and unsecured. We'll talk about that next week. And there's investments into private entities like trusts, joint ventures, partnerships, and LLCs. Now, I will just make one point real quick. And as we talk about this, you can invest through an entity and that entity ends up owning real estate. That's one way that you can buy real estate in your IRA. You don't have to do it that way, but we'll talk about the differences here in a minute. But those are just some of your options when you take title to real estate. So let's talk about the considerations and then we'll get into the case studies. Number one, before you take a self-directed IRA and buy real estate, ask yourself the question or have a conversation with one of my IRA specialists. We can't tell you how to structure the deal, but we can at least give you some things to think about or some food for thought. How are you going to take title? Okay. Most of our clients, when they're using their self-directed IRAs to buy property, they're just taking title in the name of their IRA. It's no different than saying taking title in your Fidelity IRA to your stock certificates. Okay, I'll show you what taking title looks like in your IRA. But ask yourself the question, am I going to just have my IRAs take title, or do I need to set up an entity and have my IRAs fund the entity and the entity take title? To us, it doesn't matter. Okay, there's just a different way to process each investment, but there's nothing wrong with setting up, say, an LLC, having the LLC take title to the property and the IRAs fund the LLCs prior to. You can also fund it through a trust. You can have IRAs fund a trust and the trust take title to property. Now, why would somebody want to use an LLC or a trust? They don't necessarily give you added asset protection, because when you're talking about asset protection, a lot of people use LLCs, for example, for asset protection, but who is it protecting? It's protecting themselves personally from any liability that that investment might have. Well, when you're talking about your IRA, it already has that sense of protection, meaning if I buy a property in my Roth IRA and something happens, well, it's isolated to my Roth IRA because my Roth owns it. I don't own it, so it's not going to come back to me in most cases as far as any legal issues. So do you need an LLC to give you added asset protection? No. Do you need a trust? Well, trusts don't necessarily give you asset protection, but they can give you anonymity, right? So again, every investor is different. So if you're looking for, I guess, the ease of use of an entity or the anonymity of an entity, more power to you. We can tell you how you can use your IRAs to fund those entities, and the entities take title to the property. It's really up to you. Number two, who will manage your properties? Now, this is something that you want to keep in mind, because with the IRA rules, you have to be careful on how active you are on the investment. And when we talk about real estate, let's be specific with real estate. As the fiduciary to my IRA, I have a responsibility to find investments, make it grow, and then I get benefits from distribution, right? We kind of covered that. But I have to be careful on how much I'm a part of that investment, because I still have to be passive and hands-off when it comes to my IRA's assets. So when you buy real estate, can I find the real estate that my IRA buys? Yeah, of course. No one else is going to find it. I have to find it. If I own a rental property in my IRA, can I pick the renters that rent the property? Yeah, I can pick the renters. I can't rent it to myself. That would be prohibited. And then when it comes to fixing the property up, can I hire contractors to fix the property up? Yes. Can I be the contractor? No. Now we're crossing into where you're using your brawn, not your brain. And the IRS has several problems with that. One, they don't want you to be an active participant in the investment like that, because when it's IRA owned, they don't want you touching those assets outside of distribution. The other thing is they can view it as what's called an excess contribution. You're contributing your own skill and labor to drive the value of the property up, when they only want contributions made by you in cash. Okay, so contributions into your IRA can only be by cash. It can't be through skill and labor. You really just have to quarterback the deal. You put the pieces together. You have non-disqualified people manage it for you, and everything is within the rule book, I would say. But that's textbook answer. I will say this. There's probably some situations where you might get yourself in a pickle. I know how real estate works, where you might have to go over and maybe fix something, screw in a light bulb, maybe touch up a little bit of paint, right? Toilets leaking and the tenants call you and saying, hey, it's ruining the wood floors that were just installed. Situations like that, I would say use your best judgment, right? But if you're actively the participant of putting the wood floors in your IRA owned property, or putting the third bedroom addition on, or using your construction company to rehab the property owned by your IRA, you're probably going outside of what the IRS wants you to do. So again, when I say manage, I have that in quotation marks. You don't want to be the contractor on your property, but as far as managing it, being the good fiduciary and quarterbacking the deal, well, you have to do that to a certain degree. Now, number 3, how much capital do you have and where is it coming from? On our first case study, I'm going to show you how a client, husband and wife, actually used 3 different accounts to buy property and why they did that and why that made sense. But ask yourself the question, how many accounts do I have? Okay, and which capital sources do I want to use? So if you have a Roth IRA, your spouse has a Roth IRA, you've got a health savings account, and you've got a couple kids Coverdales, right? All of those can participate in the investment, but they have to start at the investment on the front end. Okay, if you buy a property with your Roth and your wife's Roth, and then you want to have your HSA do the rehab, that's not what's called a parallel transaction. Okay, so always ask yourself the question, what accounts do I want involved in the deal? What accounts make sense to be involved in the deal? And make sure that you structure that accordingly and have all of those accounts go in at the beginning of the investment so that all of those accounts can share in the profit. Now, what happens if you don't have enough capital to buy what you're looking to buy? Or what happens if you just want to use some of your IRA money and just put a down payment down on a property? Can you get financing? Yes. Actually, I've done this on a couple different courses, and we're going to touch on it 2 more times in this coming month's workshops. But the ability for your IRA to borrow money is a great opportunity that you might want to look at. Okay. There are banks that have IRA loans. Okay, IRA loans can help you buy property you wouldn't normally be able to buy because you only have a limited amount in your IRAs, or allow you to buy more property with the use of debt. Okay, if you manage the debt properly, you could see exponential returns in this case. Okay, but understand that when your IRA borrows money, your IRA is the borrower. Okay. Banks like, and I'll give you a couple names that you can check out. I don't recommend or promote any of them, but just some banks that I'm familiar with that have these IRA loans. One is North American Savings Bank. Their website's nasb.com. You can check them out. They're one of the largest, I guess, national lenders when it comes to IRA loans. You could check out First Western Federal. You can also, if you're local to Florida, you could check out Equity Max. There's a long list of IRA lenders out there, but just remember, it's not you qualifying for the loan, it's your IRA getting the loan. And since it's an IRA and it doesn't have credit or income, most of these financial institutions, they're just looking for a larger down payment than normal, typically 30 to 35% down from your IRA, and the bank will finance the rest, yada, yada, yada. So great opportunity to leverage bank financing with your IRAs and 401ks. But ask yourself the question, remember, am I using financing? Where's the capital from before going into every deal? And then number 5, I've actually had this question several times during the week because it's just kind of that time where people are thinking about their required minimum distributions. Here's why it's important to consider this prior to buying real estate. One of the differences between buying real estate versus buying a stock is that real estate's obviously tangible, but it's harder to sell real estate than it is to sell a few stocks or a few shares in a company in Walmart stock or Tesla stock. Now, why that's important in this conversation is that when it comes to RMDs, which are required minimum distributions, okay, if you don't know what RMDs are, here's what they are. If you have, say, a traditional IRA, a SEP IRA, a simple IRA, a 401k, a pre-taxed account that you haven't paid taxes on yet, once you hit the age of 72, the government says, hey, you're getting old now. you have to start taking distributions out of this account because you've deferred all your taxes and we need our taxes at this point. So at 72, what they say is that you can no longer make contributions and you now have to take distributions or you're penalized. Now, what happens if all of your retirement in a traditional IRA is invested into a piece of real estate and there's no cash to take the distributions? This could be problematic. Now, does it happen very often? Not very often, but it is something to think about is, will your asset have some cash in to satisfy RMDs past age 72? And there's definitely a lot of solutions to getting around this. One, last week, we talked about doing Roth conversions. A Roth conversion will eliminate RMDs forever, at least in your lifetime. Other solutions to taking RMDs, if you've got an IRA that's got a piece of real estate, you can always satisfy your RMD with another financial institution. You don't have to set, for instance, if you've got a Fidelity IRA and a Nuview IRA, if you want to just keep your Nuview IRA, rolling with your real estate, you just take your RMD from Fidelity. You can satisfy all of your RMDs if you've got enough stock to sell at Fidelity. But I actually like the Roth conversion opportunity. It just gets RMDs out the window. You've already paid all your taxes to Uncle Sam, and Uncle Sam can't bug you. But these are some of the considerations I wanted to just touch on prior to buying real estate in your self-directed IRA. So let's look at case study one, and I'm actually going to show you the forms that the clients would fill out as they do this. So steps in the process. Let's just look at it real airplane view. Okay. The first step in the process, if you want to start buying real estate in your self-directed IRA, is first establish a self-directed IRA. If you don't have one, reach out to us. You can reach out to my IRA specialist at a few different places. You can use retail sales at nuviewtrust.com, or you can use our IRA specialists at nuviewtrust.com to get in touch with one of my IRA specialists. They'll help you kind of figure out which accounts are right for you and help you get set up with those accounts. The next step is obviously set up the appropriate accounts that you have, but the next step is finding or funding your IRA. There's three ways to fund it. You can fund your, you can fund your self-directed IRA with a rollover from a 401k or an old, 403b or an old employer plan. You can roll money into a self-directed IRA, do it that way. You could just transfer some funds, transfer some money from Fidelity over to a Nuview Trust Company, or just make a contribution to your plan, just like you make a contribution anywhere else. Once you've got the account open and funded, then if you want to buy real estate, there's a couple things that you would want to submit to us as your IRA custodian. One is you submit to us the purchase contract, and we'll go over this here in a second. You submit to us the purchase contract showing that your IRAs are listed as the buyer. We sign the purchase contract. And then with that purchase contract, we need what's called our purchase packet. You just fill out our real estate purchase packet. It's real self-explanatory. It's your way of giving us the authority as your IRA custodian to make that purchase of real estate. Okay. So once you've provided us the purchase packet and the contract, we'll actually sign everything. We'll sign the documents. We'll work with the title company. We'll work with getting everything funded and titled in the name of your IRA, and all the money, earnest money, the final funding at closing, all comes from your IRA. You just quarterback us as to where we're sending money and how and when we're sending that. Okay. And then as you go along, you might have some IRA owned expenses. You might have property taxes. You might have some bills that need to be paid. You might have a mortgage payment on there. If you've got a non-recourse loan, as part of our service, you would just instruct us to pay the bills out of your IRA. So you're just quarterbacking the deal. Nuview is handling the rest and dealing with all the money going in and out. So let's talk about this first case study. So have clients Robert and Linda. They both have Nuview Roth IRAs. They also set up a Coverdell Education Savings account for their 9-year-old son. Now, they had set this up a couple years back, and they had made a couple years contributions. Okay. Now, the contributions to a Coverdell are relatively very small. Right? It's $2,000 per child per year. So I would say if you want to start including Coverdell Education Savings accounts for your kids to be a part of your investments, start setting them up today and start getting some money in there, because you can only put so much in. Now, the power in it is that you can partner Coverdells with your own accounts. And this is kind of why I wanted to show this case study here, because this is exactly what Robert and Linda did with their accounts and their son's Coverdell. So They found a property, and this property was right in their neighborhood. It was right down the block from where they lived. They saw that it was abandoned. They did a little work to try to find out who the owner was, found out that the owner was, somebody that inherited the property and lived out of state. So they ended up actually negotiating a deal to buy the property with their full intent to have their IRAs and their son's ESA be the owners of that property. Okay, so they negotiated to buy the property for $100,000, and they estimated that they needed about $30,000 in repair. Okay, so total cost in this investment was $130,000. And here's how the breakup was on the money that was used. And it's important to see the breakup because this is how when you first buy the property, these are the percentages that would be used as far as ownership percentages. So the husband used $78,000 from his Roth. That was an even 60% based on the 130. The wife's IRA put in $45,500, which gave it an even 35% ownership. And then the Coverdale, after they made a couple years contributions, put in $6,500, and that was a 5% owner when it was all said and done. Now, again, they went all on this in together. They paid the contractors the $30,000. So this is pretty even numbers. And they made it easy because you can make it easy based on what percentages that you want to abide by. So these are the percentages that they use as far as capital. And here's how they took title to it. Okay. On the contract, these are the owner, or these were the buyers on the contract. Okay. They didn't use an entity. They didn't use an LLC. They didn't use a trust. They just made the purchase contract list the names of the buyers, which in this case were Nuview Trust Company, FBO Robert Jones, Roth IRA account number 12345, as to the undivided interest of 60%. Nuview Trust Company, FBO Linda Jones, Roth IRA account number 12346, as the undivided interest of 35%. And Max Jones, Roth IRA, or actually this was ESA, I apologize, ESA as to the undivided interest of 5%. Okay. Now, when you closed on the property, those are all the names on title as well. So those percentages are very important, especially when it comes to ownership on title. And we keep track of those, the percentages here at Nuview. So as soon as profit comes in on this investment, once they flipped it, all of the profit that comes from the title company is going to be split pro rata, 60 to husband's Roth, 35 to wife's Roth, and 5% to their son's ESA. Okay. They fixed the house up, paid the contractors the 30 grand to get it fixed up. They just quarterbacked the deal. They didn't do any of the rehab themselves. And then they put it back on the market. 4 months later, they sold it for $189,900. Net proceeds after closing costs were $180,000, which gave them a completely tax-free gain of $50,000. Now, remember, I didn't say tax deferred. I said tax-free because they used Roth IRAs instead of traditional IRAs. And since the son's Coverdale education account works the same way as a Roth, his part of the profit is also tax-free, but they can use that profit to pay for Max's qualified education expenses, which he's in private school. So they used a little bit of this money to pay for his private school tuition. Okay. Great scenario, an investment they could have bought with their own personal money. They could have qualified for a loan to do it, but if they did it personally, they would have been taxed as income to them. And since they flipped it, they would have had to pay short-term capital gains, which could be very expensive to them. One thing I'll just mention too, and this is not to get political by any means, but pay attention to some of the legislation that's out there right now that's suggesting that they're going to raise capital gains tax. They're going to start, if it passes again, and it's all hypothetical at this point, if it passes, they're going to treat long-term capital gains in the future as short-term capital gains. So it's not even going to matter whether you flip it or not. If we go in even past a year or whatnot, you're still going to have to pay, quote, short-term capital gains tax on your investments. So how do you get around that? How do you work around a potential increase in capital gains tax? Do it in an account that doesn't pay capital gains ever. Roth IRAs, ESAs, any of the IRAs, you'll never have to pay a capital gains tax on, and even better with these accounts that I mentioned here. So let's look at the breakdown after they were done. So they had $50,000 of profit, okay, total, and how it was split was 60% of the profit went to husband's IRA. That was $30,000 tax-free. Wife's Roth IRA got $17,500 tax-free, and the Coverdale got $2,500 completely tax-free that can be used today. Now, you could just plug and play too. Could they have put their HSA in that transaction? Sure. Could they have put their SEP IRA in that transaction? Sure. And here's the cool thing with these investments too, is that depending on what how the investment's structured, you can plan which accounts make more sense for the investment. Again, they use these accounts because that worked for them. But let's say you're doing a shorter term investment like this, where they flipped it in 4 months. I would make the argument that use the accounts that you can use the money right away. Use ESAs, use HSAs, because again, you don't have to wait to retirement to take the distributions completely tax-free or penalty-free. But if you've got to use the Roths and the traditionals because maybe they're not invested, or you need to partner those accounts because you only have so much money in the Coverdell and HSA, then sure, that works well. But think about this too, on the flip side. What if you're doing a longer term investment? Okay, what if it's a real estate investment? You're buying property subject to, right? Subject to is you're going to negotiate with the seller and buy property with underlying financing still on it. There might not be any equity in the property. It could be a very good investment, but you might not see actual profit from that investment for, say, 10, 20 years after the note's paid off or whatnot. Well, you might want to think twice about having a Coverdell or an HSA in that investment. More Coverdells, because remember, Coverdells, you want to use that money right away to pay for education expenses, but you don't want a Coverdell invested in something that's really long-term where you're never going to see the results of it, and your kid's going to be out of college by that point. So again, you could look at this, you can be creative with it. I say use as many accounts as you can. And in this case, they used the accounts that they had set up, and they did very well for themselves on an investment that they found in their neighborhood and sold it to an end buyer and provided the American dream of home ownership through their IRA investments, which I think is another ancillary benefit to all this. How did they actually process it on the Nuview side of it? Okay, so this is helpful to anybody under, okay, I understand the case study. How does it actually work and play? On the left side of the screen, I just have basically our main page when it comes to our purchase packet for real estate. If you read it there, it's real self-explanatory. What's your name? What's your account number? What's the property address? Who's the title company, right? Are there any expenses that need to be paid? Where are we sending the money? Really, really simple. A lot of people have this misconception that buying real estate in an IRA is really complicated. It's not. It's actually buying real estate can be really complicated, but using your IRA is not complicated. It just means you have to work through us. Okay. And we can't, as a self-directed IRA custodian, we can't do anything without you giving us the direction to do that. So unfortunately, there's no button to push to buy real estate. You still have to work through the process of buying real estate. And how we take direction from you saying, hey, Nuview, I want you to invest my money in this, is you just submit us that purchase packet, which the page there on the left. With that, you also want to provide us the purchase contract. Okay, we need a copy of the agreement. And in this case, we just kind of made an example. Here's a copy of the agreement. You can actually see that the parties were, there's a seller there, ABC123 LLC is the seller, but you can see right underneath there, the buyer is Nuview Trust Company, custodian, FBO, name and account number. Okay, that's really it. You're doing the same legwork. You're just putting your IRA as the buyer. And then you're not signing the contract, because we would sign because we're the IRA custodian. Remember, you're not buying the property, but you're still putting the pieces together. We would sign the contract, and the money, including any earnest money, including any option fees, that would come from the IRA and sent to the title company or attorney's office. So it's really simple. Purchase packet, copy of the contract. Now we have a real estate department. We have a transactions department that will walk you through this and make sure T's are crossed and I's are dotted. And you can have direct access to them to help walk you through this process. And by this point, we've seen every investment known to man when it comes to alternative investments. So they're very, very knowledgeable. We've been doing this since 2003. So there's not a real estate investment that we haven't seen or funded at least a couple hundred times. So, but this would be the bare knuckles, bare minimum what you would need. And along with also wiring instructions where we're sending the money. Really, really simple stuff here. Let's look at another case study as well. This is just another bonus case study that I wanted to show. This is a client that actually rolled over some money from an old 401k. Now with 401ks, remember, those are pre-taxed accounts. So when you roll over an old 401k that's all pre-tax, that is going to roll into a pre-tax traditional IRA. Okay, keep that in mind for the case study because it's kind of important to the story. Okay? But he rolled over his 401k old employer to a traditional IRA and bought a 4-unit property for $185,000. Okay, now we made the offer. He made the offer on the contract in the name of Nuview Trust Company, FBO, his name and his account number, just like we mentioned before. Once we took title to the property, that is the owner of record. Again, he didn't use an LLC. He didn't use a trust. He just took title in the name of his IRA. But he actually did pretty well for himself because he started renting the 4 units out. And even after expenses, he was netting $1,850 a month. So this was not a flip. This was a buy and hold. Okay. Now the $1,850, remember, that's profit to the IRA. So that comes back to Nuview, and then Nuview deposit that into his IRA or IRAs, all completely tax deferred or tax free. The rents do not go to him. Okay, he's not putting them in his bank account. That would be prohibited. The money goes to his IRAs, and then he could decide if he wants to take distributions out of the IRA. Now, on this property too, just to mention, he was not having each tenant send rents to Nuview. He could do that. He could say, hey, tenant 1, tenant 2, tenant 3, tenant 4, please make your checks payable to Nuview Trust Company, FBO, your name and account number, and send it to Nuview. He could do that. And he can also even instruct us to pay expenses as expenses come due on this property. He didn't want to do that though, because I would say in most cases, it's hard to argue that a property manager doesn't make sense in this circumstance. He hires a property manager. The property manager is responsible for collecting the rents. The property manager is responsible for paying the expenses. And then whatever's left over, they send that as one check to Nuview, and the property manager keeps their, say, 10% fee there. Again, time is money. I would say I've seen a lot of people run into issues because they're trying to self-manage. And remember, you don't want to manage the property. Just have a property manager do it. And it makes it a lot easier, especially if you have multi-unit properties like this. And when you look at the $1,850 that he was getting net, and this was his average over the course of the first 12 months, that's a 12% return on his money. Okay, 12% is phenomenal. I think if someone would tell you you can make 12% on this investment, pretty much guaranteed, okay, and it's only going to go up, most people would do that investment all day long. Because remember, when you're talking about real estate and rents go up every year in most cases, right? So this investment actually was bought back in 2009. Okay, that was his rents back then. Today, it's well over 20% are his rents coming in on an annual basis because his purchase price doesn't change, but rents go up. Okay. Now, he didn't have a loan on this property. This was all bought cash. Okay. And he hasn't sold this property, so he hasn't had to, assume any capital gains. But if he did sell the property, remember, there's no capital gains tax on this. Even in a traditional IRA, there's no capital gains because you can roll over all of the profit to the next investment. So all your gains are technically deferred. Okay, so in this case, all the rental income he's generated over the course of the last 10 years, okay, all of the appreciation, which he hasn't assumed yet, but everything, because he did it in his IRA, is completely tax deferred. But if he would have done this in a Roth IRA, which is really important to consider Roth conversions, if he would have done this in a Roth IRA or a Roth 401k, or even an HSA, or had an HSA or ESA involved, well, those profits would be completely tax-free. So if you do the numbers in your head, would it have made a lot more sense for him to do a conversion prior to doing the investment and maybe own the investment in a Roth IRA? Yeah, you can probably make a strong argument that that helps. But again, I think this is a good investment nonetheless. And it just goes to show you the power of an IRA is that you eliminate any taxation on the rental income and you eliminate the taxation on capital gains. And if you do it right, regardless of whether the property goes up or down in value, you have rents. And that's one of the cool things with real estate is that there's multiple streams of income. It's very different than a stock that's not tangible. There's just a lot of benefits. And that's why we like talking about it so much here at Nuview. So just wanted to give you that case study so you can see actual numbers from actual clients on how they've kind of performed. And I hope this really helps you guys understand how to buy real estate in your self-directed IRA, specifically your self-directed IRA at Nuview. I'm going to take questions here in a second, but I do want to mention one thing as well, is that if you are in the state of Florida or you're near where we're located in Longwood, Florida, we're going back to live classes. We're going to start this back starting this every Thursday of the month. And we're going to start this in September. So our first class here in our classroom is going to be September 16th. We're going to start at 6 p.m. And we're going to talk about how to make big bucks in small accounts. So I'm really going to dive into those HSAs and those ESAs. If you're interested, what type of investment strategies can you use for small accounts? I think you kind of saw at least one of them, which is partnering. Partnering is very, very critical. If you've got small accounts, do you have some larger IRAs that you can partner together? Or do you just have anybody who's got some IRAs together? You don't have to partner with your own IRAs. Maybe you partner with other clients. So one of the good things of these live classes is not only the ability to learn some of these investment strategies that our clients are using, but also gives you the ability to network with local investors. And we had a great turnout for our first class. I asked the audience, when did they want to do it? They said, let's do this at least once a month. So we're going to start them in September, and it's going to be on a recurring basis every third Thursday of the month. So be excited to have you guys there. There is a code there if you want to scan that, but you can also register for any of these on our website as well. And we'll also post comments in the link on Facebook to give you guys an idea there. Let me see. I can't see questions on here, guys. So you're going to have to relay them to me. Do we have any questions that need to be answered? Let's see. All right. So Dawn, looks like we've got that answer. Can I take depreciation? Oh, here's a good question. Can I take depreciation on my tax return for the rental property owned in my IRA? So the answer would be no. Okay. So, but here's kind of what I want to say about depreciation. One is depreciation is a great thing when you're investing in real estate, more as an individual. So I think that you should invest in real estate to capture depreciation if you need it. But what are you using depreciation for? You're using depreciation as a tax credit to offset taxation to you as an individual. In an IRA, there is no depreciation because there's no tax. There's nothing to tax, so there's no reason for depreciation, unless your IRA is in a position to be a taxpayer. Now, one of the things that we'll talk about in our next coming classes that I've talked about on previous classes is that if your IRA leverages money from a bank, if your IRA borrows money, there is some taxation on the money you borrow. Okay, so in that case, when your IRA does have to pay a tax because it's debt leveraged, well, then you can use depreciation in that case. So going back to the original question, though, can you use depreciation from your IRA's investments to offset your own personal taxes? Unfortunately not, but that's why I think most of our investors invest in real estate inside and outside of their IRA. So outside of your IRA, if you need the depreciation, yeah, you should buy real estate outside of your IRA. But also look at your IRA. How can you create some completely tax-free wealth investing in real estate through your tax advantaged accounts? Here's one thing that I hear. Again, not picking on anybody, but I hear, a lot of CPAs or, qualified wealth advisors say, I would never buy real estate in an IRA because you don't get depreciation. That's a moot point because, like I mentioned, you only need depreciation when you're offsetting tax. So just because you don't get depreciation on real estate, that doesn't make it a bad investment in an IRA. And then also, what's your alternative when somebody says that to you? Don't buy real estate in an IRA because you don't get depreciation. So what are you telling me? I should just buy stocks instead and make less money? So I should invest in something I understand least and make less money because I don't get depreciation on my real estate in an IRA. Again, it's just a moot point, but a great question. I get a lot of that all the time is they're always wondering about depreciation. I say buy real estate personally and buy real estate in an IRA. There's an advantage to doing both. Great question. Nancy, thank you for the question. If you purchase the property with a Roth IRA and it passes to a daughter, does she have to make RMDs if it's inherited? So very, very good question. So with Roth IRAs, if you're the owner of the Roth IRA, you're the one that set it up, you're the original owner. There's never RMDs on those. If you pass, any IRA you pass is going to have RMDs to the beneficiary because by definition, it's not their retirement account. They just inherited it. So if your daughter was to inherit a traditional or a Roth, she's going to have RMDs, and it's going to be based on a 10-year period. They've changed the rules recently. So based on her age, typically when she inherits a traditional or Roth IRA, she has to take required minimum distributions as an inherited IRA over the course of the next 10 years. Here's the thing I'll mention with that, though, is that, again, you want to think long-term wealth. Passing on a Roth IRA as an inherited Roth IRA is actually one of the greatest gifts you can give to somebody. So the mere fact that they have to take RMDs is not the end of the world, but passing on a Roth IRA is still passing it on tax-free to your beneficiaries. If you have property in the Roth IRA and it's passed as an inherited asset in that inherited IRA, they'll have to take RMDs. Hopefully the rents will cover some of those RMDs, because the investments don't go away. The investments still live on in an inherited Roth IRA, and your daughter can even sell that property and buy new property in the inherited Roth IRA. It can still be invested, but it's a completely tax-free vehicle that can be invested regardless of her age. She does have to count for the RMDs, though, so that is a great question. But I often see this is that people actually keep their investments in a traditional IRA and pass that on. And here's the difference with passing on that same asset in a traditional IRA. They have the same RMDs, but now they're the taxpayer. They've got to pay, not only take the RMDs, but they have to add that as income to themselves. And most of the time, beneficiaries are still in their working years. So that just adds more income on top of the income that they're already making. So again, I think in passing on an inherited Roth IRA with real estate is one of the greatest things you can give to somebody. Let's see. Will your classes be on Zoom also? Yes, we're going to live stream that. I would encourage people to attend, though, if you're looking for the networking aspect of it, but we will broadcast those live on Zoom as well. Thank you for that question. Jose, if I wanted my self-directed IRA used for lending, is there a minimum amount to sit in my IRA? Who finds the borrowers and what rates apply? How long is the term? A great question. One, I'll encourage you to log in or register for our class next week where we'll talk more about that, but I'll answer your question nonetheless. So if you want to use your IRA for lending, there is no minimum amount to use. So we have no minimum account balance that you have to leave here at Nuview, but you have to have just at least enough in there to do whatever loan that you're looking to do. Who finds the borrowers? You find the borrowers. Okay. Now, how do you find those borrowers? You can find them in your own network, your own sphere of influence. You can find them at local RIAs. A lot of our clients who are lenders go to local RIAs to network with local real estate investors. You can come to our classes if you want to join our classes, either live or remote. There's nothing wrong with saying, hey, I'm Jose, I'm a, lender. If anybody's got any deals in, Central Florida or wherever you're located, let me know. Right. So the one catch is that unfortunately you can't come to us and us say, hey, here's all the people looking to borrow money. I wish we could do that. But since we're a self-directed IRA custodian, we can't share that type of information in that fashion. But what we can do is put people in a room, either virtually or live in our classes. So however you can get out there and network and find people, that's how you're going to find your borrowers. And again, stay tuned to the class because we'll talk about rates and all that thing as well, because it's really you structure the deal between you and the borrower. You guys come to an agreement based on what your IRA is going to charge as the lender and what they're going to be willing to pay and how they're going to pay that back. But it's actually a really good investment. I actually do loans over anything else because it's less work for me. I don't have to deal with toilets and tenants. So we'll talk a little bit more about that next week. Don, you may have already answered this under the people restrictions. I own property. Can my IRA buy it? Yeah, we talked a little bit about that. Remember, as an IRA, as the IRA's owner or the IRA's fiduciary, you can't self-deal with your own IRA because it's a conflict of interest. You make decisions for your IRA, and you can't make decisions for your IRA to benefit your IRA when you're buying things from yourself. So it has to be purchases from non-disqualified people. Now, could you sell property to other people's IRAs? Yeah, I see that all the time. If you are in a real estate group, I always mention this, because you can't self-deal with your IRA and yourself, that's fine. Find some financial friends. Find maybe some people that have IRA money and who are also real estate investors. Maybe I can sell my property to Bob's IRA, and Bob's not a disqualified person to me because Bob needs an investment in his IRA and I'm trying to sell this house. And then maybe down the road, I have the same situation where I'm looking for an investment for my IRA and maybe Bob has an investment that he wants to sell me. The important part about that is it's not a disqualified person that my IRA is doing business with. So use your sphere of influence and just realize your IRA can only do business with people who are not on that disqualified person's list. So your IRA can't do business with yourself, your spouse, parents, grandparents, kids, grandkids, or any entities that those people are associated with. Anonymous, great class. Thanks for the info. I appreciate that. Thanks for tuning in. Linda asks, when you invest in income producing real estate, is there UBIT or UBIT? Usually there is some financing, some deals, and it is a business. So if you are, it's a great question. So if you buy property cash, okay, IRA puts all cash. There's no debt. There's no financing. There's no unrelated business income tax. There's no taxation to the IRA whatsoever in that business, okay, or in that investment, I would say. If your IRA was to put a down payment down, let's say 40%, right? My IRA is going to put $40,000 down, but my IRA is going to have to borrow $60,000 from a bank. Well, in that case, my investment, since it's $60,000 borrowed and the investment's say $100,000, my investment's considered 60% debt leveraged. I didn't use all IRA money. I used unrelated money to my IRA to help buy the property. So when I have unrelated money, that's when unrelated business income tax kicks in. My IRA would have to pay taxes based on the debt leverage percentage, not all of the profit, just a percentage of the profit based on how much I borrow. But it's a moot point if my IRA is just buying property and it's all cash. There's no taxation to the IRA. Now, there are some arguments, okay, that will say if you flip property, it can be perceived as a business, okay? Consult with your legal professionals. I see it I've actually rarely ever seen it taxed as a business. They can make this argument that buying and selling property under a year is considered dealer property. The only circumstances I've seen where clients actually were buying and flipping real estate and the IRS called it dealer property is they were doing large volume of flips in their IRAs. The only circumstance I've ever seen it in my 10 years is a home investor that owned a home investor's business, had bought and flipped 30 properties in 1 year in his IRA. Now, in that circumstance, based on the amount that was done and that how the investment basically mirrored his home investor's business, they deemed it a business, which doesn't make it bad. It just means that the IRA would have to pay taxes like a business. If you're just buying and selling in one property though, or even two properties, I would say, and you're flipping them, it's very hard to call that a business. Is it a business when you buy and sell a stock within a year? No. So what's the difference of buying and selling a piece of real estate within a year? Now, I understand the rules and how language can be interpreted, but I'm just telling you, it's not low-hanging fruit. I've never seen somebody buy and flip a property and have the IRS deem it a business. It's never been done. So buying and flipping property, done, no taxation involved there. So let's go. Any other questions? Are property taxes, insurance, and monthly expenses deductible on yearly tax return from the IRA owned property? Another great question. This goes back to the similar point I made with depreciation. If the IRA is paying tax, the IRA can use depreciation and expenses to offset the tax. If there's no tax, you don't need to use any of that because there's no tax to offset. So again, we're back to that situation. If my IRA borrows money, can my IRA use depreciation and use the expenses to whittle down the income to give me lower net income? Yes. If my IRA invests all cash, I don't have any taxes to depreciate against or have any taxes to use expenses against. So hopefully that answers your question. And Linda asks, investing in syndications. So investing in syndications is something a lot of our clients do. So for instance, a syndication would be somebody's raising money to buy something large, right? It could be a large apartment building. It'd be a skyscraper. It can be something large where they're raising millions of dollars to buy a property, and they're raising money from people's IRAs. Now, if you're investing in a syndication, and I'm assuming you're asking about taxation based on your last question, UBIT, you got to ask yourself the question. It goes back to what's the syndication doing? Will that create taxation to the IRA? If the syndication is borrowing money, then the same rules apply when it comes back to your IRA as being a taxpayer, because ultimately the entity, if somebody's using an LLC, and here's oftentimes what happens. Somebody's raising money to buy an apartment building. They're raising capital from IRA investors. They're going to use that capital to put a down payment down, and they're going to finance the rest from a lender. Okay. Well, in that case, the IRA ultimately owns debt leverage property. It's just through an LLC. So again, doesn't make it bad. It just means that if your IRA is invested in a debt leverage property, or it's invested into an entity that's running a business, then you do have to look and see, is this going to create taxation to my IRA? But even if it does, then you can use depreciation, you can use expenses to help whittle down any taxation, if there is any. So final thoughts I want to say on that is, even if your IRA is in a situation where it has to pay a tax, which is very rare, it doesn't make it a bad investment. And I will say this, all of the taxes that I've seen after it's calculated, find a good CPA that understands unrelated business income tax. After depreciation and expenses are added into the equation, the taxes are not that bad. And actually, when you look at it, and I have some calculations in the next couple classes I'll do, when you look at cash on cash return, a lot of times your cash on cash return goes up because you have the ability to acquire debt and help you take a certain amount of capital and make significant returns. Eliminating the debt might eliminate the tax, but it doesn't make the cash on cash return any better. So it really just depends. I always tell people, UBIT or UDFI is something to be aware of, not something to be scared of. But again, if you're just investing your IRA cash, no debt, no business, no tax to worry about whatsoever. Great question. And then Melissa, if you buy a vacation rental with your Roth IRA, is it considered a business and tax? Another good question. So let's address that. If my IRA buys a vacation rental, okay, in most cases, that's just viewed as a rental, right? You can call it vacation rental or whatever. But if it's just you're buying a property and you're renting it out, okay, most cases, it's not going to be taxed, okay, because it's real property. It's not a business. Now, let's talk about when you do something like Airbnb, okay? Or let's say you own a rental property and you're doing short-term rentals. Now, short-term rentals by definition are usually you're renting it for 7 days or less on a recurring basis. Now, what that changes in the scenario is when you're renting short-term, 7 days or less, well, by definition, you're running more of a hotel. And obviously you run into this when you do Airbnbs, if you're doing short-term rental, you're viewed as operating more like a hotel. And in that case, you're viewed as more of a business. So it depends on what type of a rental activity you have. It's not necessarily whether it's vacation or not, it's whether you're doing long-term rental or short-term rentals. And there's some great articles online to talk about that. Again, doesn't make it bad. I see people make a killing with Airbnbs, whether it's short-term or long-term. But if you were considered about being your IRA treated like a business, then just invest it into things that are long-term rentals and not short-term rentals. That would be my suggestion there. Okay, great question. Let's see. Thank you, Nate. Great class as usual. Thank you, Linda. I appreciate that. Rick, does title to real estate have to be changed if I want to convert a traditional IRA that owns real estate to a Roth IRA? Great question. I suggest that you change it because it does make the process clean. You want to have a clean paper trail. So let's say you own property and it's owned by your traditional IRA. If you do a conversion, should you change title to a Roth IRA? I would say it probably makes sense to do that. Legally, do you have to? No, there's no law that says you have to, provided that you have a competent IRA custodian that knows that you've converted it to a Roth. It's really just a matter about how the income comes back, right? Because you're going to pay taxes outside of changing title, right? When you do a conversion, you're going to get a 1099 that shows your converted amount. You pay taxes that has nothing to do with the title of the property. We would probably ask that you change the title just so we have clear documentation showing that it's owned by a Roth or a certain percentage is owned by the Roth. But as long as we're tracking the income back to the Roth now and it's not going back to the traditional, that's fine. So yes, I would encourage you to change title. Are you going to go to jail if you don't? No, not at all. So great question there. Let's see. Dawn says monthly rental. I'm not sure what you mean by that. If we're talking about short-term or long-term rentals, I think that might be what you're talking about, but let me see, you type something else here. Monthly rental. business. So again, I think you're talking about Airbnbs, monthly rental. Again, you can look it up, but most of the time it's considered 7 days or less from what I've read. If it's a residual 7 days or less, that's considered short-term. Anything longer than that can be considered more long-term. And again, we're only talking about whether or not your IRA is treated as a business. If your IRA is owning property that's more in the longer term rental process or longer term rental leases, you're not going to be treated as a business. And again, if you're doing short term, doesn't make it bad. And then Jose said, if I already have a property with a non-recourse loan and the property had significantly appreciated in value, can I refinance it with cash out and use the money to remodel the property and to potentially get better rental rates? Yes. So that is one of the, and here's another thing, Jose, I'll mention because you brought up a good point. If you own property currently, can you get a refinance or can you get a loan on that property and give some cash back to your IRA to buy more property? Yeah. So yes, the benefit of these non-recourse IRA lenders is that you can tap into the capital of your IRA owned properties to either buy more property or add some rehab. If you don't have any other sources to pay for the rehab, you can use some of that money from the lender to add rehab dollars to increase the value of your IRA and get some better rental rates. So great question. I love that topic of, because most people don't even realize your IRA can borrow money. And again, great questions. And I appreciate that as well. What's up, Maggie? You're trying to show me something. How long? Okay, now another one. How long does money have to sit in a Roth IRA before I can take a distribution? I am over 60. So money in a Roth IRA, here, I'll just answer this question and we'll wrap it up here. Money in a Roth IRA, there's seasoning with a Roth IRA. How long a Roth IRA has to have money in it? Well, first, when you take distributions from a Roth IRA, it comes out in a certain order. It's called ordering rules. The first set of money that comes out of a Roth IRA are your contributions. Contributions can come out anytime, tax-free and penalty-free. There's no age that you have to wait. There's no seasoning. Any money that I put in, I can take out since it's after tax. Okay, so if I've made, say, 10 years of contributions to a Roth, I've got $60,000 of contributions. I don't have to wait to 59 and a half. I can take that money out anytime I want, tax-free and penalty-free. The second set of money that comes out of a Roth IRA is any conversions that you've made from your traditional IRAs to Roth IRAs. You pay the taxes on the conversion. You might pay a penalty based on not having it not seasoned for 5 years, but it doesn't prevent you from taking a distribution. It just means that you might have to pay some taxes on the profit made on that conversion if you take it out, before 59 and a half, or you don't have it seasoned for 5 years. But if you're over 60, just to answer your question directly, I would say if you're over 60 and you've had the Roth IRA open for 5 years, okay, we're not talking about converted amount, you can start taking distributions anytime, tax-free and penalty-free. You now have qualified distributions once you have a Roth IRA open for 5 years and you're above the age of 59 and a half. So great question. I hope I answered that for you guys. And thank you for tuning in. And I will answer, Rick, I will answer this question separately since we're just wrapping up. If you get a screenshot of that, Maggie. And I will encourage people to register. Go to our website. We've got all the classes up there. If you go to our education resource page, you can register for our next upcoming class. The reason I say that is that even if you miss the class and you don't see it live, you get a copy of the recording, and it's just good to have the recording in your email. And if you are interested in setting up an account through the month of August, we've got a special promo. We're calling it our +1 promo. Contact one of my IRA specialists, ask them how you can utilize the +1, but it's really more than a +1. It's basically when you set up an account for yourself, there's a $50 application fee. But if you set up one for yourself, you can set up as many as you want for other people for no application cost. So if you want to set up one for your spouse, if you want to set up ESAs for your kids, if you want to set up an HSA, we're not going to charge you an application on any of those. So all you got to do is open one account and you can get the rest with no application cost. Just use the promo code +1. Maggie, nice images there. I love it. Summer is on us. And then again, stay up to date with Nuview. Follow us on Facebook, like our page so you get notifications when we go live. Follow us on YouTube, subscribe to our YouTube channel if you can, and also visit our education resource page on our website. Thank you guys for tuning in. My name is Nate Hare, and we'll see you guys next Wednesday for Nuview's Wednesday workshop.